The US economy is at a turning point. Inflation remains above the Fed's target, the job market, once a pillar of strength, is losing momentum, and the dollar is starting to weaken as the Federal Reserve shifts into rate cutting mode. These changes raise some big questions. Will inflation finally settle down? Could the labor market soften further? And how will the Fed's cuts ripple through markets? In this video, I'll break that all down. We'll look at where inflation and jobs are today, what the Fed and other central banks are likely to do next, and what it all means for stocks, bonds, currencies, and commodities. By the end of the video, you'll have a clearer view of what to expect for the rest of 2025 and beyond. Let's start with inflation. The latest figures show prices are still rising, but not necessarily spiraling out of control. In August, headline inflation came in at about 2.9% year over year, while core inflation, which leaves out food and energy, held at 3.1%. So what's keeping prices up? Tariffs are raising the cost of imported goods. Services like shelter and travel are also still expensive. And food prices jumped 0.5% in just 1 month, the biggest increase since early 2023. Now here's the key point. Inflation is sticky, but companies are absorbing some of those costs instead of passing them on to consumers, at least for now. That's a possible sign that demand is slowing and is helping to keep inflation from spinning higher. Now let's talk jobs. The labor market has been a pillar of strength for the economy, but cracks are starting to show. Unemployment claims recently hit their highest level since 2021. Payroll growth is cooling, and companies are cutting back on hiring. This doesn't mean layoffs are everywhere, but employers are treading carefully. For the Fed, that's a big signal. Inflation is one side of the story, jobs are on the other, and a softer labor market gives them room to shift gears. So, where does the Federal Reserve fit in? After holding rates steady for 9 months, the Fed has finally made its move. In their September meeting, they decided to cut rates by 0.25%, bringing the benchmark overnight rate to 4% to 4.25% range. And this is likely just the beginning. Most Fed officials project at least 2 more cuts before the end of the year, with one outlier, likely Fed Governor Miron, projecting 5 by December. The idea here is simple: keep inflation from flaring back up, but prevent the job market from sliding too far. History shows that when the Fed starts cutting rates after a long pause, it often sparks a wave of easing around the world, and that's exactly what we're seeing. Zooming out, more than 90% of central banks have already cut rates this year. The European Central Bank, the Bank of England, and the Bank of Canada have all eased rates, with the outlier being Japan. The Bank of Japan is actually tightening policy, moving away from years of negative rates. When most central banks are cutting together, markets often see it as a tailwind for equities. The last time we saw broad-based easing like this was back in late 2024, when the Fed kicked off its current cycle. And if you go back further, to the early 2000s, similar periods of synchronized easing lined up with strong stock market performance. Now let's look at the US dollar. When the Fed cuts rates more aggressively than other central banks, the dollar usually weakens. Historically, the dollar falls most against the euro and the yen. The Canadian dollar also tends to strengthen, while the British pound is more of a wild card. For Americans, a weaker dollar has 2 big effects. It makes exports more competitive overseas, but it also makes imports and travel more expensive. So, what does this all mean for investors? For equities or stocks, broad global easing is usually supportive. Stocks like liquidity, but margins could stay under pressure if input costs remain high from inflation. For bonds, falling rates do usually help, but what happens for short-term bonds may be different than longer-term bonds. With inflation risks still in the mix, don't expect long-term yields to just collapse. However, short-term saving yields will likely drift down, so money markets, your savings account, those are likely to get less interest as time goes on. For currencies, dollar weakness could create opportunities in international markets, particularly in Europe and Japan. As for commodities, a weaker dollar often boosts demand for dollar-denominated commodities like gold, oil, and even crypto. Here are some of the key takeaways to keep in mind. 1. Inflation is sticky but not spiraling. It's still above the Fed's 2% target, especially in food and services, but it's likely not accelerating out of control. 2. The labor market is cooling but not collapsing. Unemployment claims are rising, but hiring is slowing. However, layoffs remain limited. 3. The Fed has started cutting rates, with more likely to come. That means cheaper borrowing costs, but also lower savings yields. 4. Most central banks are easing, which usually supports markets. More liquidity tends to be a tailwind for equities and risk assets. Number 5, the dollar looks weaker ahead. That helps US exports and commodities, but makes imports and travel more expensive. Overall, these changes bring uncertainty, but also opportunity. At Pacific Wealth Management, we're closely monitoring all of these trends. Rate cuts, a weakening dollar, and global central bank coordination all impact portfolios. Our focus remains on proactive management, navigating risks, and seizing opportunities to protect and grow wealth. Whether you're investing, saving, or planning for the future, staying informed is key, especially now. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, be sure to visit us at www.pacwealth.com.